The US markets are sliding into dangerous territory after an astonishing run in the S&P, where the index flipped from negative to positive 12% within just a couple of months. What felt like unstoppable momentum is now beginning to unravel, and we are staring at the edge of either a long overdue correction or a far more painful collapse. Fed Chair Powell has already fired warning shots, openly admitting that American stocks are overvalued, with people paying far too much for assets that are increasingly untethered from reality. We are in bubble territory, and bubbles, no matter how bright and inflated they seem, always burst. What shoots up must eventually crash down, especially in today's chaotic economic climate where trade wars rage, the dollar weakens, and US bonds are not only underperforming but outright shunned by both domestic and international investors. This flood of desperate money has been racing into anything that still offers a glimmer of return: gold, equities, speculative bets. But the overvaluation we are seeing in equities is breathtaking, almost surreal, and it should be setting off deafening alarm bells. The P/E ratio today is climbing to the same extreme levels we last witnessed in 2020, right before the pandemic triggered a furious collapse. And now, once again, history looks ready to rhyme. American stocks are currently trading at a 41% premium compared to their 20-year average, an insane number when you consider the fragile state of the broader economy. Why is so much capital pouring into the US market at a time like this? The answer lies partly in the AI gold rush. Tech companies are building massive data centers at a breakneck pace, and investors are chasing the dream of trillion-dollar industries being born in real time. On top of that, there's the promise of shakedown money, massive investment inflows from Japan, Korea, and the EU, capital that will supposedly be funneled into US industries and infrastructure. On the surface, it looks like America is sucking in the world's wealth. But beneath that glitter, the foundation is crumbling. Large corporate investors, who usually act as the ballast of financial markets, have gone all in. They are holding only 3.9% of their portfolios in cash. That means their liquidity is almost completely gone. Their ammunition is spent. If the market flips suddenly, they will have no reserves to defend their positions. They won't be able to buy the dip. Instead, they'll be forced into panic selling. When the tide goes out, they are naked, exposed, and vulnerable. This is how crashes are born, not from slow declines, but from the sheer weight of everyone rushing to the exit at once. The next question is whether foreign investors, who play a massive role in supporting US equity markets, will stay the course. That hinges on the dollar. Dollar cycles last a decade or more, and while today's fall has lasted less than 12 months, the Fed's actions will determine whether that slide becomes a collapse. In just the past 3 days, US equities have already fallen 3%. It doesn't sound catastrophic, but the psychology behind it is shifting fast. And the words of new Fed Governor Stephen Moran only add fuel to the fire. He is aggressively pushing Trump's agenda, calling for rapid and deep rate cuts to save the economy. In his view, the Fed risks permanent damage if it doesn't slash rates immediately. He wants cuts of at least 50 basis points, maybe more. But what is the true neutral level of interest today? 3%, 2%, 1%, or something even lower? Nobody can agree. The danger here is clear. Slashing rates too quickly may breathe life into inflation, which has already proven sticky, while masking structural weaknesses. US GDP growth of 3.8% in the last quarter looks impressive on paper, but peel back the layers and it becomes obvious how distorted that figure is. Much of the growth is false demand generated by tariffs. When imports are cut off, people are forced to buy domestic goods, and that inflates GDP artificially. It isn't organic growth, it's a reshuffling of numbers. The economy looks stronger than it is, but the illusion can only last so long. Meanwhile, the so-called safe haven of US Treasuries has become a graveyard of lost wealth. Over the past 5 years, 30-year bonds have delivered annual losses of around 10%. Investors fleeing to bonds for safety have been punished, while the S&P has rewarded risk-takers with annual returns of 15%. But that reward comes with extreme volatility, wild swings of 2, 5, even 10% in a single trading day. The danger of another April-style crash is ever present. No one can predict whether the crash will happen tomorrow, next month, or next year. But what is undeniable is that US stocks today are sitting at some of the richest valuations in history, even as geopolitical tensions escalate and the global economy stumbles. All it takes is one spark, an escalation in US-China relations, the imposition of a new round of brutal tariffs, or a sudden black swan event, and the house of cards will come tumbling down. Bank of America has tracked 20 different metrics on valuation, and 19 are screaming overvalued. PE ratios, price to book, operating cash flow, every measure points to danger. As all of this plays out in America, Europe is sinking deeper into its own crisis. Since the Russia-Ukraine war, the EU's industrial base has been decimated. Trump's tariffs compound the damage, hitting exports right when Europe needs them most. In the first 5 months of the year, the EU exported over $300 billion in goods to the US, making up 20% of America's imports. Now a 20% tariff threatens to crush that lifeline. Prices will spike, demand will collapse, and European factories will face ruin. German business confidence has already nosedived, and the EU's largest manufacturing economy is buckling under the pressure. Yet Europe continues to follow Washington blindly. They cut themselves off from cheap Russian gas in favor of overpriced American LNG, $750 billion worth of it. They pledged $600 billion to invest in U.S. industries by 2028. Every move strengthens America while weakening Europe. It is economic self-sabotage, as if Europe is playing Jenga against itself while blindfolded. The EU is effectively subsidizing the U.S. economy, a complete reversal of the post-World War II order, when Trump, despite blunders elsewhere, has played his allies masterfully. He has fenced off U.S. markets against EU exports, while Europe bleeds. The results are undeniable. EU exports fell 3.4% in the second quarter, another 0.4% in July, and in June exports to the U.S. collapsed by 10%. At the same time, Chinese exports to the world were rising, proving that Trump's tariff war is weakening allies more than adversaries. Worse still, Trump is preparing new pharmaceutical tariffs. Europe, a major supplier of medicines to the U.S., will take another crushing blow. The frustration in Europe is boiling over. Their industries are hollowed out, their economies weakened, their political will hijacked. And yet Washington keeps pressing for more loyalty, with Besson now demanding Europe grow a spine and impose secondary sanctions on BRICS to punish Russia further. The EU is trapped, bleeding economically, yet still chained to an ally that exploits them. We are entering a world where markets are overvalued, liquidity is gone, allies are weakened, adversaries are gaining ground, and the global financial order teeters on the brink. It only takes one spark to ignite the chaos. And when it happens, the crash will not be gentle. It will be violent, fast, and merciless. This whole situation is almost absurd to even compare, and yet the fact that such a comparison arises says something deeper. Russia is not about to march into Boston. Nobody believes that. But the very idea underlines a fundamental truth. The United States has always benefited enormously from geography. The Atlantic Ocean acts as a colossal shield, separating it from the chaos, rivalries, and entanglements of continental Europe. That natural moat has spared America from the kind of vulnerabilities Europe cannot escape. But today the conversation is not about military invasion, it's about economic survival. And in that realm, Europe's shield does not exist. Instead, it faces a harsh reality. The United States, once considered its irreplaceable ally, is becoming an unpredictable competitor, a partner that demands obedience while simultaneously strangling European industry with tariffs, sanctions, and inflated energy costs. For the longest time, European leaders believed they could balance Washington's demands with their own economic ambitions. But slowly, reluctantly, some in Brussels are waking up. They are beginning to grasp that the trajectory of global commerce, growth, and influence is shifting eastward, and the gravitational pull is toward BRICS. The United States can threaten duties, unleash sanctions, and try to bend its allies to its will, but the cold numbers don't lie. Trade expansion, market size, and future demand are in BRICS nations, not in America or even in Europe itself. The only rational path for Europe, if it wishes to remain relevant, is to start aligning with this new center of gravity. And in many ways, the pivot has already begun. The clearest sign of this reorientation is the sweeping trade agreement between Europe and Indonesia, a nation that recently joined BRICS. This is not some minor adjustment, it is a monumental step. The deal eliminates tariffs on nearly all goods exchanged between the two sides. For the EU, that means unprecedented access to one of the fastest-growing economies in the world. For Indonesia, it opens the floodgates to advanced European products at lower costs. Officially launching in January 2027, the agreement is projected to save European exporters at least $600 million annually, and that's just the first layer. Because Indonesia is not the final destination, it is the gateway. Right now, Europe cannot trade directly with Russia due to sanctions. Its relationship with China is bogged down by tariffs and political tension. Any serious attempt to dismantle trade walls with Beijing would immediately provoke Washington's wrath. Relations with India are also stuck, partly because Brussels echoed American calls to punish nations buying Russian oil. That closes off another channel. So what's left? Indonesia, a country with massive demographic momentum, rapidly industrializing, and strategically positioned as a hub connecting Europe not only to Southeast Asia, but to the broader BRICS. And Indonesia itself is no small prize. Its population is set to surpass the United States in size. Its demand for consumer goods, technology, infrastructure, and industrial machinery is expanding at a staggering pace. Under the new trade deal, duties on European cars, currently suffocating at 50%, will drop to zero in 5 years. Levies on European machinery, an industry in crisis back home, will fall from 30% to zero. Agricultural exports, processed foods, and other staples will also gain access with fewer restrictions. For Europe, this is not merely a trade pact. It is a lifeline, a survival strategy. Because the uncomfortable truth is this: the days of exporting to the United States are numbered. America's tariff war ensures that European products will be priced out of its market. And under Trump's aggressive Made in USA doctrine, Washington is moving to shut out foreign competition altogether. Exporting to China is no solution either. Europe's production costs are so high that Chinese buyers can easily find cheaper alternatives elsewhere. That leaves one realistic move for Europe: relocate production. Shift factories, transfer supply chains, and start building plants in places like Indonesia, where costs are dramatically lower, resources are abundant, and access to BRICS markets is open. This is no longer theory, it is happening. Volkswagen, one of Europe's industrial giants, has already announced a colossal $5 billion investment to establish an electric vehicle ecosystem in Indonesia. Their objective is straightforward: slash production costs, secure raw materials, and plug directly into BRICS-linked supply lines that offer cheap Russian energy and steady Chinese inputs. Such a move would be impossible in Europe today, where energy is unaffordable, regulations suffocate competitiveness, and industries are collapsing under pressure. Soon, more European corporations may follow Volkswagen's lead, constructing new manufacturing hubs across Indonesia and other BRICS-aligned nations to salvage what remains of their industrial base. And the implications are enormous. Once Europe embeds itself into BRICS supply systems, its dependence on the United States will decline sharply. Access to Russian energy, Chinese manufacturing networks, and the growing consumer base across India, Indonesia, Brazil, and beyond will reshape Europe's future. This is about more than raw materials. It's about survival in a world where the West is shrinking while the global South is rising. Now look at the bigger picture: the IMF's forecasts for global growth. Between now and 2029, the engines of expansion are not in the G7. They are in BRICS nations: India, China, Russia, Brazil, Egypt, and Indonesia. Even before the tariff war, America's growth projection was modest at around 11%. But with Washington turning inward, isolating itself, and prioritizing protectionism, the U.S. is increasingly transforming into a closed economy, a fortress market. Meanwhile, BRICS is unifying, consolidating, and accelerating. The conclusion becomes impossible to ignore. Europe needs BRICS far more than BRICS needs Europe. The United States is doubling down on constructing its own insulated hemisphere-wide economic bloc. BRICS, on the other hand, is consolidating, with India returning closer to the fold, Russia and China steering integration, and resource-rich countries like Indonesia taking center stage. Europe has no luxury of choice anymore. The pivot is no longer optional, it is a necessity. For Europe, all roads now lead to BRICS. The only unanswered question is speed. How quickly will Europe shed Washington's grip? How rapidly can they relocate industries, sign trade agreements, and plug themselves into the BRICS orbit? Or will hesitation, division, and fear leave them stranded between an America that punishes them and a BRICS alliance that moves forward without them? What we do know is that the trade war is just the beginning. The tectonic plates of global power are shifting beneath our feet, and Europe is standing at the crossroads with the clock ticking down. So I'll leave you with this. Are US markets standing on the verge of collapse? And how desperate is Europe's scramble for survival in a world where its old strategies no longer work? Share your thoughts in the comments, stay safe, and don't forget to hit that like button and subscribe as we continue following these dramatic, world-altering transformations together.